Good afternoon, everyone. We welcome you again to one of our live webinars. We hope you're all you all attended. You all managed to attend well. So please send us a message saying that we can you can hear us well. Just anyone.
Come on, guys. We need just your feedback quickly, just to ensure that you can hear us out loud and clear. It's Andria, by the way.
So thank you very much. Everything fine. So we welcome you to our introduction to Elliot Wave Analysis. This is the second part following a previous webinar made by Andria. So we'll go through the usual stuff and then we'll start.
Yeah, so guys, today we decided to do a joint webinar with Nektarios. So I will start the webinar just with an overview of what has been covered in part 1, Elliot Waves part 1. So before we start, let me go do as usual. For any kind of questions, just stick it in the box. There's no problem. We'll try to reply to you as soon as possible. If we don't manage for any reason to reply, please send us an email with your questions at webinars@hotforex.com. So I have to actually read out loud the disclaimer. So let me go through this text. This material is provided as a general marketing communication for informational purposes only. Nothing in this communication contains or should be considered as containing investment advice or an investment recommendation or a solicitation for the purpose of purchase or sale of any financial instrument. We make no representation and assume no liability as to the accuracy or completeness of any information provided. We shall not be held liable for any loss arising from any investment made based on the information provided in this communication. This communication must not be reproduced or further distributed without our prior written permission. Risk warning: trading forex and CFDs may not be suitable for all investors and carries a high degree of risk to your capital. Trading such products is risky. You may lose all of your investment capital. So admin is out of the way. So let's go through. Here's me and Nektarios. Okay, we're both market analysts here in Hot Forex, guys. I think you recognize our faces. If you attend, of course, to some of the webinars that we are giving every week. So me, it's Andria, and Nektarios, my colleague.
Hello again. So yeah. I think you know us all from the start. No need to make another further introduction about what we are and what we do. So why don't we just go directly to starting the second part of our Elliot Wave Analysis. Okay, so let's start then. So before we go, we'll have Andria give us a short review of what happened in the first part of the Elliot Wave analysis.
So guys, how many of you you attended the first part, or is any one of you not familiar with Elliot Wave Analysis? Just a quick yes or no, and if I'm just checking whether I should spend more time on the review of part 1. So Saleb, that no is because you haven't attended or you are not familiar with Elliot? Okay, let's wait for the reply. Okay, cool. So we have people attended. Okay, thank you for your replies. So as what I have covered actually last time, guys, it was an introduction of Elliot Wave Analysis. So what Elliot Wave principle is another technical tool. However, the tricky part and the interesting part about Elliot Wave is that it's not only emphasizing or let's say doesn't only consider the trend reaction and the price action. It also locates extremes in investors' psychology. So it takes into account also the investors' psychology. So with Elliot Wave principle, we can actually analyze the market trend, and we can actually forecast any potential market movement. However, the tricky thing is with this one is, as I said, it doesn't only, it is not only a technical analysis, it is not only based on price action and on the momentum and volatility, but also allocates the psychology of the investors. So that's why it's quite of the more significant principles in the markets so far. So it was developed by Ralph Nelson Elliott. Is someone, it's an accountant actually that for the 30 years time he was traded on stocks market mainly, and that's why he created this tool, okay, because he wanted to achieve to achieve to his trading strategy. He wants to improve himself and gain, of course, more as a trader. So let's move on. So the basic principles of Elliott Wave theory is that, as you might already aware, market it moves in a repetitive wave. So that's why sometimes we are saying that the history is very important. If you go back, you will see the same patterns repeat themselves. So market price moves in a repetitive wave. It has a fractal nature. So as we are saying in mathematics, we can see fractals almost everywhere, like in nature, like a broccoli is a fractal. Don't have the picture to show you, but what fractal nature means, it means that we have a pattern that repeats itself, okay? So you can see that also in this picture, in this graph. So you can see that in the wider picture, we have this triangle and this move, so up, down, up, down, up, down. So it's a repeatable pattern. Also, if we zoom in, we'll see that the same pattern, the same pattern repeats itself in a smaller range. So we have this repeated. Elliott Wave is actually suggests that forex market, stock markets, bond market, whatever, it moves in a repeatable wave. It has a fractal nature. So as you can see over here, every action is followed by a reaction. If we are going up, we will see at some point we'll see a move downwards. If we are moving downwards, we will see a reaction and move upwards again. So every action is followed by a reaction. So just quickly, Elliott Wave, think it as a 5 waves move, okay, which goes along with the trend. So if we're in an uptrend, we will see 5 waves, 5 movements, 1, 2, 3, 4, 5. You can see that also in this picture, might be clearer for you. So Elliott Wave is suggests that we'll have in the market a 5 waves moves along the trend, so in the same direction of the trend, and 3 corrective waves. So the 3 corrective waves are usually represented by A, B, C. So they are going against the trend. So while we are in an uptrend, the move downwards, the move against the trend, is represented by the corrective waves, which are usually 3. So we have 5 impulsive, this is how we call them, 5 impulsive waves, and 3 corrective ones. I'm sorry. So also if you like zoom in this 5-3 pattern, so you can see that it repeats itself. So you have another substitution of the next higher 5-3 wave. So if I like focus on the first wave, if I like try to see in a smaller scale, I'll see that again it does the same pattern, the 5-3 pattern, 5 up, 3 down, 5 to the upside and 3 to the downside. And that's why we're saying that's a fractal nature. It repeats itself in any single scale. So that's quickly, let's move on because we have to cover more advanced details. I will pass to Nektarios the next slide.
So remember that this 5-3 movement is actually repeating itself. So let's see what happens when we're about to face a bullish and a bearish market. So remember that when we're in a bullish market, so the overall trend is upwards, right? So expect to see that the main movement is indeed upwards. So this is the image on your left-hand side. So essentially what we're seeing is that we have three impulsive, we call impulsive the ones that are in green in this case. So we've got 1, 3, and 5, which are moving upwards, and we have two smaller corrective wedges, 2 and 4, which are moving against the direction of the trend. This is a general principle for the markets, and then this is how we expect them to unfold. So usually the trading is in the direction of the impulsive waves. So the idea is that the corrective wave is not going to be that long. I mean, as you can see from the image, we expect a corrective wave to be much smaller than the impulse wave. Okay. So in contrast, when we see a very big corrective wave to the downside, when we move from the end of wave number 5, the impulsive wave, as we have called it, to facing the big correction wave. So we've got A, B, and C. As you'll notice here, A and C are longer waves than wave B, and they are indicating that we have a correction to the downside, and we suggest that this is the end of the uptrend. So this is the same idea in the bearish market, only things reverse. So in this case, the impulsive move is the downwards move. So impulsive, again, we repeat that it means that this is going to in the direction of the overall trend. Okay, so if we have a downtrend, the impulsive wave is looking down. If we've got an uptrend in a bullish market, then the impulsive trend looks up. Okay. Again, the idea is that we always trade in the direction of the impulsive waves. So largest price movements occur in the down waves. Then, when we reach the end of point of wave number 5, we start moving, in this case, in a corrective upwards movement, in contrast to the downwards impulse we had before. Then, how can we be sure that this is a correction and not the end of a wave then? How can we have an idea of how things are moving? So Elliot Wave provides us with a nice understanding of how this works. So in essence, we say that, you know, this is a wave so long that, for example, the first rule is quite simple. Wave 2 cannot retrace more than 100% of wave 1. So if wave 1 started from, say, 100 and moved to 150, then wave 2 cannot go below 100. If it goes below 100, then we do not really say that we observe a long, we have seen the start of an impulse movement. We may be seeing something else. We'll see later on how to decide on what this is, but we cannot really say that this has been an impulsive movement. In addition, wave 3 can never be the shortest of the 3 impulse waves. It doesn't have to be the longest. Usually it is, but the case could be that wave 3 can be shorter than wave 5, or it can be shorter than wave 1, but it cannot be shorter than both of them. And finally, rule number 3 is that wave 4 can never overlap wave 1. So if wave 4 goes so low that it has actually crossed the line of wave 1, so if it goes below this line over here, then we say that, okay, we have a problem, we're not seeing correct impulse reaction. So what we're seeing is essentially something else, and what we will look differently to solving what this issue is.
So guys, basically, just in summary, if you don't see these rules satisfied, then you don't have an Elliott wave, okay? As simple as that. And those rules are quite important because they will help you to enter the market, okay? Especially on the next slide, excuse me, where we have the relationship between Fibonacci and Elliott wave theory. It gives you some particular points on where you could actually enter the market and trade either to the upside or to the downwards. Excuse me. So if you have a confirmed Elliott waves based on the three rules that Nektarios just mentioned, then you have to see whether it satisfies the below guidelines that we used in these guidelines, the Fibonacci extension and the Fibonacci retracement. So wave 2, which is a corrective wave, okay, typically must be more than 50% of wave 1. So you understand that it needs to be not as big as 1, not as long as the length. It doesn't have to have the full length of 1, but it needs to be at least more than 50% long of wave 1. So it's typically 50, 61%, 76.4%, or 85.4. So it cannot be. It cannot have the same length as wave 1, but not also less than 50% of wave 1. So we are referring to the length of it, okay? Wave 3 on the other side, as Nektarios mentioned, it can never be the shortest one of the three impulsive waves of wave 1 and 5. So it can never be the shortest one. So a guideline for wave 3 is that it typically is more than 161.8% of wave 1 and 2. So if you put your Fibonacci on wave 1, you will see that the extensions of Fibonacci should be more than 161.8%. So we'll have some examples later, and you'll see these Fibonacci extensions to be applied as well. So yeah, it needs to be more than 161% of wave 1 and 2. Wave 4 typically is more than 14.6% of wave 3. So by setting your Fibonacci on the fourth wave, on the corrective fourth wave, it needs to be more. The length of it needs to be more than 14.6% of wave 3, and not more than 38.2%. It can never be more than 50% for sure. That's something that you have to highlight. It cannot be more than the half of wave 3. And wave 5 is typically up to 61.8%, and the maximum 123.6% of wave 1. So okay, so this is just some guidelines.
Before we actually finish, so remember something, guys. So why don't we say that wave 2 has to be more than 100%? Because remember that if it goes below 100%, if it goes below this line, they were saying that, you know, we're not having a typical Elliott wave formation. So then this point means that if we observe more than 100, we have a problem, okay? So wave 3, it could be anything of these things. It could be even longer than this thing, but it usually is not, okay? So it doesn't matter so long as wave 3 is big. But remember again that wave 2 cannot exceed this line here. The same holds again for wave 4. So remember something, if it goes below than 50%, then this means that it will go in the area of wave 1. So we don't want wave 4 to come into the area, to overlap the area of wave 1, okay? Then if it does, we're again saying that, okay, this is not what Elliott wave theory suggests. If this happens, then we do not really observe. So if it declines by more than 50%, it means that it has covered more than half of the increase in wave 3. So this means that it is by construction below wave 1. Okay. Then wave 5 can go again as long as it should. However, again, it is typically not that long. Usually the longest wave is wave 3, but it could be the case that we observe something different. So this has been the overview of what we did, what Andria did on the previous Elliot Wave webinar. So we'll start now with going through to Elliot Wave Analysis in the second part.
So what we're going to cover today is a more advanced concepts of Elliot Wave Analysis. So we're going to see motive waves, corrective waves, and we'll see some examples on how to determine your entry, stop loss, and exit points when you trade based on Elliot Wave Analysis. So we'll have further examples either that we have from posts that we already posted in our analysis page or new ones, just for you to get a better understanding of the particular principle. So first of all, guys, motive waves. So the traditional definition of Elliot waves of motive wave is that a 5-wave move is in the same direction as the trend. We already said that. Remember the impulse that we were saying in the part 1 is along the trend, so they have the same direction. So we have 3 kinds of motive waves: impulse waves, impulse with extension, and diagonal. Okay, so the difference of what we have seen so far is that the motive waves in an Elliot wave analysis, they don't have to be 5 waves. In today's session, we will see that motive waves can unfold in 3 waves. So it's not necessary to have a 5 movements. We could have 3. So let's start with the first type of motive wave, which is impulsive wave. So impulsive wave is subdivided into 5 waves. Okay, as you can see from the picture, we have one move to the upside, down correction, up again, down correction, and up again. But if you zoom in, as I said, if you zoom in to impulse wave 1, okay, you see another subdivision of this movement. So you could see another 5 movements to the upside, to the direction of the trend. While on the corrective waves, you will see 3 movements to the downwards. Okay, so it says 5, 3, 5, 3, 5. Okay. So what you have to take care of once you see a movement like that. So you have to take care that wave 2 cannot retrace more than wave 1. So it can never reach the start point of wave 1. Okay, we already mentioned that in the previous slide. So it's the same. It's the same principles. Wave 3, on the other hand, can never be the shortest one of the 3 impulse waves. By saying impulse waves, we are referring to the first move and the third move and the 5th move. So the ones that they go along the trend. Wave 4 can never overlap within the price territory of wave 1. So the corrective wave 4, it goes against the trend, correct? But it can never, as Nektarios said like before, it can never go as down as the peak of wave 1. Wave 5 needs to end with momentum divergence. And what we mean by that is like it's likely that we will see on wave 5 at the end of it, we'll see the momentum reversing. So if we are in a positive momentum, a very high positive momentum, is likely to see this momentum decreasing and reversing to the downside. This is mainly the same as we have seen before. Sorry. The same principles hold if you zoom in. Let's say if you go in a smaller scale, you will see the same pattern. Okay, that's why you can see this in a smaller scale. You see that we have the first movement with an I, then the corrective wave with double I, then triple I, and the corrective moves to the downside as A, B, and C. So I will not go through this because it's the same as we already covered 2 slides before that. So I will move to something more important, which is the leading diagonal. It's something that we have not seen so far. So in this 5 movement pattern, this Elliot wave pattern, it is likely to see what we are calling leading diagonal. So it looks like a triangle, an ascending triangle. So what we actually mean by saying is a kind of the leading diagonal is a kind of a special type of motive wave. Okay, so if we subdivide the wave 1, we will notice that there is another move, another Elliot wave pattern satisfy the wave 1. So usually the leading diagonal can be identified if we subdivide the wave 1, which is impulsive, if it is impulsive, or if we subdivided the wave A in a zigzag pattern. So this is a 3-wave pattern. We'll see zigzag in a few later on. So it is consistent by 5 waves again. Okay, so we zoom in, focus on this pattern over here in the wave 1. Okay, so wave 1 it consists by another 5 waves. So 1, 2, 3, 4, 5. Right? Okay. So again, the same principle holds. So wave 2 can never overlap wave. I can never reach the beginning of wave 1. Wave 4 can never overlap the peak of wave 1. Can never go as down as in the peak of wave 1. And the other thing that you have to take care of is that they are usually in a wedge shape. So what do we mean by that? If you connect the peaks, so the peaks of wave of movement 1, movement 3, and movement 5, and if you also connect the lows of corrective wave 2 and corrective wave 4, you will see a wedge. Okay, so a leading diagonal, the submission of actually of a leading diagonal can be either 5, 3, 5, 3, 5, or 3, 3, 3, 3, 3. What we mean by that is simply the 5 waves that they are consistent to this wedge. They have inside of them like either 5, 3, 5, 3, 5 movements or 3, 3, 3, 3. So.
Okay, let's go to the leading diagonal now again. So remember we saw before that this leading diagonal leads to a subdivision in wave 1. So what we see is, remember that in this case, wave 1, i.e. the first wave of the diagonal, is usually the longest. Similar to the general principle, remember we're talking about fractals here. So what happens in the long also happens in the short run. So what this means is that we have to observe that wave 3 cannot be the shortest ever. So again, what we said before, it could be that this is the second longest, it could be this is the third longest, etc. But it can never ever be the shortest of the three waves. So the leading diagonal can be confirmed in the position of the first wave of an impulse wave. So it can be confirmed about here, or of wave, or in the case that we have a zigzag correction. So in this case, as you can see, we start with A, B, C, which is a downwards movement. This occurs in a downwards market. Then we have again A, B, C. Again, this occurs in the direction of the trend. Then again, A, B, C in this case, and again on this case again, A, B, C in the fifth wave, ending the leading diagonal. Then we can go on and we'll see the corrections. Again, we move to the end. We move to wave number B. Okay. So the same idea holds for a downtrend, and we can confirm it after essentially this first wave is over, or we can confirm it over here as well. Okay, so it's the same idea. We've got three wave movements, and these go in the general direction of the trend. So the same idea holds with the ending diagonal. So what we're saying is that again, when we have this longer wave, so we have the long-term wave, which is 1, 2, 3, 4. What we can observe is that wave number 5 is actually starting to look like it's entered this little diagonal wedge here. So similar to what happened before. So instead of starting here, instead of the diagonal being observed in wave number 1, we see it occurring in wave number 5. So look where this is going. So we're going up, and we have wave 1. We're going down, we have wave 2. Up again wave 3, down again wave 4, and up again wave 5. Okay, so what this suggests is that there is no overlapping between waves 4 and 1. So as you can see, it stops here. It doesn't overlap with the area. And we have a 3, 3, 3 ending diagonal. So we've got 3, as we said before, 3, 3, and so on and so forth. The same idea would also hold in the end of a correction wave. So if this is a correction wave, remember that the correction wave happens once the impulse waves have ended. So again, the impulse waves are those which tend to focus on tend to follow the general trend, and the correction waves are the ones which move against the overall trend. So this is the forecast here. This is the 333 trend here, and it shows again the same point. So it has to happen again at the end. So this is the ending point here. This is the ending diagonal. So again, wrapping up with the ending diagonal, either wave 1 or number I. When we say number I, we mean in this case this wave here. Okay, so we have 1, 2, 3. So either this one here or wave 1 in general are usually the longest. Similar again to what we said a lot of times until now, wave 3 can never be the shortest. So this means again that it can either be the second longest or the longest. Okay. And the ending diagonal can be confirmed in position number 5, in the position of a wave 5 of an impulse, or wave C in a correction. So again, what we're saying is that either this is going to be the last wave of the motive waves, so number 5, or it's going to be the last wave of the corrective waves. Okay.
Okay, before I move on to zigzag, you understand that you can see some principles, some guidelines. They are like, we repeat some guidelines because the same principles hold either in the whole Elliot wave analysis principle. Okay, so all these guidelines regarding that the wave 3 must never be the shortest one, and etc. are quite repeatable because this is where Elliot based his principle. So before I move on, just for simplicity of the ending diagonal, think it as like it's an upside move, right? And you're connecting the higher highs and the higher lows. So if you see these trend lines, this wedge breaking, like over here, and if we zoom in over here, okay, then you understand that if it broke down, it means that our market is reversing. Okay, that's why this picture is quite helpful because it gives you the entry point as well. So if the down movement, the corrective wave of this upside movement breaks below corrective wave 4, then your market has most probably revert to the downside, and you can enter the market short. Okay, the same holds for a bear market as well. Okay, so think it as a break of the trend line of a wedge. Okay, so let's move on. Zigzag. So zigzag is a corrective wave. So just as you understand, and as we already mentioned, corrective waves are the moves against the trend, and we have actually 5 kinds of corrective waves. We have zigzag, flat, triangle, double 3, and triple 3. So in this slide, we're gonna cover zigzag corrective wave. So zigzag usually is formed by 5-3-5 waves. So if we start with the first picture, okay, is shape. First of all, it is usually represented by A, B, and C, and it is usually in a 3 movements structure, A, B, and C. Okay. However, wave A and wave C, okay, which are of course impulsive because it's going along the trend. Our whole zigzag pattern, it goes down. So it goes down. So sorry. So they can be considered, the A and C are the impulsive ones, and B is the corrective one. So wave A and wave C can be subdivided into another 5 impulse or diagonal waves. You can see that in the next graph over here. So if we subdivide A and C, we can see another 5 movements, 3 impulsive and 2 corrective ones. 3 impulsive and 2 corrective ones. So nevertheless, wave B, which is a corrective structure, is usually subdivided into 3 movements. Okay, 1, 2, 3, and it is always the shortest one. Okay, because our trend is a downtrend, so it's a corrective wave overall. So it will be always the shortest of the 3. So B will be shorter than A and B. Also, a guideline you have to take care of is that wave B can never be less than 50% of wave A, and not more than 85.4% of wave A. So it can never be as long as wave A, but it can never be also less than half of the length of wave A. As of wave C, it will be more than 61.8% of wave A, okay? If, however, it reach up to 161.8% of wave A, then wave C can be the third wave of a 5 waves impulse. So if we go back to our Elliot, I don't have a picture of it, okay. Then it goes back to this formation, okay. And that holds if, let me go back, sorry. If, in case you see that wave C is more than 161.8%, then you go to the more simpler Elliot Wave Analysis, which is a 5 to 3 structure. So that was for zigzag. If you see also the corrective wave with double 5-3-5 subdivision is again A, which is subdivided to 5-3-5, B, 3 movements are we said, and C, 5-3-5. This is what we call zigzag corrective wave.
So moving on, we'll see the other types of corrective waves, which are flat waves. So flat waves are, in contrast, instead of seeing just a 3-5-3 as in the zigzag, we see a 3-3-5 movement. So again, remember that what we're seeing here is again an ABC wave. So we've got 3 waves, of which these can be subdivided into further waves. So have a look here. So for example, we've got 1, 2, 3 waves leading up to wave A, 1, 2, 3 leading up to wave B, and 1, 2, 3, 4, 5 leading to wave C. What's important here is that wave A and B can actually be subdivided into any type of structure. So it could be a zigzag, it could be a flat, it could be double 3 and triple 3, which we'll see later. But the important thing is that wave B needs to end close to the start of wave A. So this part here should be close to where wave A actually started. Then in wave C, what we should observe is that it should be more or less close to where wave A has started, okay? So it should be around about 100% of where wave A has started. So notice the difference between this regular flat now and the expanded flat. So the expanded flat is very, very, very similar to the regular flat, but the major difference is that we still remember that we still have the 3, 3, and 5, 4. But the main difference here is that wave C actually ends below the ending level of wave A, and not just below. It goes from 123% to 161% of the waves. So it ends quite below where wave A has ended. Okay, so remember everything else, it's exactly the same thing. Okay. The only difference is that we have wave 3, which is a bit higher, and in addition, we have the ending level of wave B a bit higher than wave A. So notice that what we're seeing here is that when we say expanded flat, it means as if, you know, imagine someone actually picking a regular flat and just stretching it a bit. It's just pulling it from the top and pulling it a bit from the bottom. And what happens is that we have essentially a stretched flat. So what we call this is an expanded flat. So we expand it, we stretch it a little bit. So that's the idea behind these waves. Okay. Same thing holds for the running flat. So notice in this case that again we have the 3, 3, and 5 subdivision. Okay. Now, what happens in this case is that wave B ends much higher than the starting level of wave A, as in the expanded flat here again, okay? But wave C does not extend beyond the point of wave A. It many times doesn't even go close to wave A, okay? So the idea is that, remember that this is the same as the expanded flat we see here, okay? But what we have here is that wave C ends above wave A. Okay, so if you look at it here, then you see that this ends higher than wave A. Okay. Then what we're left with is triangles. So
guys, we are going through all these patterns because once we cover all this, you will understand that you can actually benefit of them, and you will, if you identify patterns like that, you will be able to place your entry, your stop loss, and your potential target. Okay, that's why we're going through all these patterns right now, because afterwards we're going to show some examples and how you could actually trade based on the Elliot Wave analysis and all these motive and corrective waves. So triangles. The triangles is more of a sideways movement, okay, which is associated with volume, of course. So when the volume is decreasing, we will notice that we, by connecting the peaks and the lows of a movement, we will see a triangle. So think triangle as a sideways movement where you could, of course, benefit out of it. So triangles, okay, as you can see on the left-hand side, have usually 5 sides again, which is again A, B, C, and D. D, E, sorry, A, B, C, and D, E. So 5 sides, and each of this side, okay, is subdivided into 3 waves. So if you notice, from A to B, we have 3 movements. From B to C, another 3 movements. So it is subdivided into each side is subdivided into 3 waves. So that's why we're saying that triangles are usually formed by a 3-3-3-3-3 structure. Okay, this is what we mean by that. So as you can see over here, we have 4 types of triangles in the Elliott wave theory. So the first 2 that we're gonna cover is the ascending one and the descending one. So in the first, in the top, the first 2 are ascending triangles. So in a bull market where our asset is going to the upside, you can identify an ascending triangle if by connecting with the trend lines the peak of the movement and the lows of the movement, you will see that they form a triangle that it looks to the upside. Okay, it looks to the upside. So if you extend, if I extend those lines, okay, where's my pen? Oop, cannot. I thought I could. No. Highlighter. Is that it? No. No, I don't know why my pen is not working. Anyway, if you extend, okay, cannot do it. If you extend these lines, you can see that it's looking to the upside. Okay, so what that means? It means that if I see a break of the uptrend line, a break above it, then it means that the consolidation has now entered, okay, and my asset is likely to continue moving to the upside. If you're in a bear market, however, and you notice in this side movement again a triangle, okay, an ascending triangle. However, at the end of it, you notice that your asset is moving sharply to the downside, breaking the lower trend line of your triangle, then it means that the asset is likely to continue moving to the downside because you're a bearish market. Note that the last move after the end of the triangle, in order to claim that you continue going to the downside, you have to see a sharp movement to the downside. So your asset needs to go below D, okay, below the fourth corrective wave, okay. In the alternative scenario where you see a descending triangle is when by connecting again the lows and the peaks, you'll notice that the triangle is looking to the downside, okay. How you could benefit out of it is that if you're in a bull market and you see a break of this triangle to the upside, then again consolidation has finally ended, and probably my asset continues again to the upside because positive momentum is getting increasing and increasing. If you're in a downtrend, however, your asset is likely to continue its down movement if you see a break of the triangle to the downside, okay, below the lower trend line of the triangle. So another two types of triangles, okay, we have contracting and expanding ones. So what we means, let's start with contracting ones or symmetrical, whatever, you can find it in both names. So in a contractive wave, it's pretty much similar to it is pretty much similar to a descending one. So an descending one. So sorry, it does by connecting the peaks of this 3-3 structure, 3 movements down, 3 movements up, down, up, down. So by connecting, we have a descending triangle. However, we don't have a flat line. If you notice, if I go back, okay, you'll notice that I have a flat line. The one of the two sides of the triangles are quite flat, but in these types of triangles, we have a slope in both trend lines. So we have a more of its symmetrical, let's say, triangle. So by the break of this descending line to the upside, again we claim that we have our positive momentum increasing and is likely to see further gains to the upside. In contrast, in the bear market, we've seen again a descending line. So, and it's descending line on the upside and an ascending line to the downside. So if we see the pair breaking below the lower trend line of the triangle, again we will see that negative momentum is increasing. You can identify the decrease of negative momentum because this forms also lower highs. So by seeing lower highs, you know that there are more bears in the market and less bulls. So bears are fighting for a further down movement. Okay, it's not just the break; it's also the peaks are lower and lower and lower. Expanding triangles on the other side. Okay, they are like a reverse symmetrical. If you notice, they are. If we extend the lines, they look like vice versa. So we have at the top an incline, at the bottom again a decline. Okay, so on the break, if you reach the bottom of this triangle and reversed, on the break of D level, is likely to continue expanding to the upside. While in the bear market, on the reversal of E, if we see E reaching this trend line and reversing, then is likely to move further to the downside.
So to answer the question we got, whether it's possible to send you the document, I'll just remind you that this is recorded, so you can look at it whenever you want. After we end this will be uploaded on our webinar site, so you can watch it on whenever you want, stop it wherever you want, pause, go into deeper detail. There is no ready-made indicator. When I say ready-made, I do mean ready-made to identify the waves. So that's the difficult part of Elliot waves, but you do have the Fibonacci levels on MT4, and you will see it a bit later. So again, if you've got any questions, and don't hesitate to ask, we're here to answer them. So remember that we saw
just a second, I would like to reply something to Cornelius. It might be difficult to comprehend this webinar because it's an advanced one. So please go back and watch the part 1, and then try to watch again the part 2 that we are presenting right now. It might be easier for you to comprehend what we are actually saying.
Yeah, again, if you watch these things, the more you watch, the more you deal with them, the easier they come. So Andria's first webinar was an introduction, so it should give you the tone to understand much better on how these things evolve, and then following up with this webinar, you would get a better understanding as to how Elliot Wave moves. So moving on to with corrective waves, what we can observe really is that it doesn't have to be just one formation. So for example, it could be the case that we observe a double three, which means that in this case we've got 3 waves, which could actually be something much different. So we start here, so we have a flat correction wave. So remember, point B is higher than the start of point A, and wave C is lower than point A. So if I go back, I'll remind you that this is called either a flat or an expanded flat. Which of the two is it? Come on, guys. So remember that the expanded flat here is we observe this when B is higher than the start of A and C is lower than A as well. In this case, we see that B is close to the end of start of wave A, and wave C can either be a bit higher or a bit lower than wave A. But in this case here, what we're observing really is that we have B, which is higher than point A, and we have C, which is quite a lot lower than point A. So what we have here is essentially this one, the expanded flat. So remember that we stretch the usual flat. So this is the first we see. Then when this ends, we have just a simple 3 wave movement, and then we have the zigzag. So remember the zigzag, what we said is that, okay, we end up here, then we have 1, 2, 3, 4, 5, 1, 2, 3, and then 1, 2, 3, 4, 5 again. And what we observe here is this. So then moving on to find another type of double 3. So again, let's suppose that this was again an expanded flat. Then we see an any 3 combination, and then what we observe here is we have a triangle. So we have 1, 2, 3, point A, wave A, 1, 2, 3, moving to point B here. This is a typo. 1, 2, 3, point C, then to D, and then again to point E. Okay, so we have identified these waves here, okay, as part of a double 3 wave. Okay. Similar, we could have another thing. So instead of having a double 3 simple here, we can have a combination of double 3s. right? So we have 1, 2, 3, 1, 2, 3. So we have a double 3, right? So we got 3 waves here and 3 waves here. Then we've got just another 3 wave notice here, and then again we have 3, 3, and again 3. Okay, so that's the idea. So we can have a combination of these guys here. Even worse, or even more difficult, we can have a combination of 3 different 3s. Okay, so for example, we start with the expanded wave here. Again, we have a 3 wave here. We have a double 3. So 1, 2, 3, and a 1, 2, 3 again, and a 1, 2, 3 again. Okay, so this is the double 3 again. Then we have just any 3, and then we observe a zigzag here. So we've got 5, 3, and 5 again here. This can also be used in other things. So we can have a double 3, any 3, double 3 again, any 3, and again the double 3. Okay. So what's the summary we have here? So remember that the first wave is an up move, which is called, so this is an uptrend. Okay. So remember that all we need to know is that we have psychological aspects, and the 5-3 wave pattern is the one that holds. Okay. So remember that wave 1 is just the first move caused by traders who feel that the valuation is low and price should go up. So you say, well, you know what? Oh yeah, price is going up, it's going up, it's going. But then they say, oh yeah, right. But remember that you know, I bought about here, so I'm quite happy selling here. I'm making some profits. Sure, why not sell? So people start selling. However, it doesn't go that high. So people who are observing this say, you know what? Okay, prices have gone low, but they're lower and they appear more attractive now. So what should we do? Oh yeah, we should buy some stock prices here. So they start buying again, okay, and they push the price higher. As they see prices going up, they don't sell. They just wait to see what's going to happen. At some point, some traders actually book their profits, but many people do not really. So we have again a short correction, but it continues. Now what happens in wave 5 is that everyone is going in. So okay, we have sustained, we have gone up once, we have seen it go down, but it didn't hold for long. Then again we went up and we went down for a while. But here in this case, everyone gets in. So very, very high prices here, very high valuations, and people actually start, at some point they start selling their holdings and even start shorting in anticipation of the corrective wave. Okay, so let's have a look at an example here.
Okay, this is an example of Euro Swiss in a weekly basis. I'd like to highlight that Elliot can be applied in every single time frame. I'm just putting this Euro Swiss one in weekly basis because it was the best representation that I could identify in order to show it to you. So someone asked before how is it possible to identify something like that, an Elliot wave. So simply by watching the candles and by watching the overall trend of your asset. Okay, so so you have initially this move, which you might didn't actually identify. So it's wave 1, the passive one. A small correction to the downside, but then a move wave to the upside again. This is what Nektarios was mentioning before, the wave 3, where everyone, like most of the market participants, identify that, oh, here we have an uptrend. Let's get in. Let's buy. So more and more people are entering the market to the upside. This in this period. So that's why we have seen this huge movement to the upside. And this overextended movement. Sorry for a second. So Sorry, we had some issues here. Then once everyone entered, like the most of the market participants entered, then some people actually wanted to take their profit, to cash out simply. That's why we have seen this correction slightly to the downside, but it wasn't sufficient. It wasn't there are not a lot of people that they actually either entering short or wanted just to come out and to get there and to cash out of the market. So again, we've seen the uptrend continue to the upside, and we had the formation of this 5 move trend, which is consists 3 impulse waves, so 3 waves that go along the trend and 2 corrective ones. Okay. After that, if you identify something like that, you might consider, okay, how can I trade this? Okay. If you identify this 5 movement, then you have to wait and see what will happen. So if, like in the Euro Swiss example, if your asset on the end of this 5th movement, it goes down, okay, and it goes below the 4th wave. This is the 4th wave, okay, 1 2 3 4 5, below the 4th wave, then you can claim, okay, I probably gonna have an extension to the downside, okay, a further downwards movement. Okay, here wasn't clear because the candle closed above 4, above the lower level of 4. So you will wait and see stance, and you could place your order once the candle closed below the lower level of wave 4. So you can, this is where you could place your entry with stop loss set at the latest peak, which was over here. Okay. That's we said that Fibonacci extensions can help with this. So you cannot simply trade the corrective wave. You could actually trade this 5 movement trend, upside trend. So as we said, by applying Fibonacci, you can actually trade as well much earlier than ABC wave. So by setting, remember that we said that wave 4 can never be less than the more than the 0.5% of wave 1. So by plotting this Fibonacci on wave 1 and by seeing that, okay, wave 2 didn't manage to go below that, okay, so it satisfies my rule. Suddenly I saw that it's reversing to the upside, so it might be the start of wave 3. And actually wave 3, it went above 161.8% of wave 1. So here, so you could place your long entry at this level, the 161.8, with stop loss at the low of wave 2. Okay, that's in simple terms how you could trend Elliott wave. So Nektarios will show you an example as well.
So let's try a different example now. Okay, so what we're seeing here is the GER 30. So this is the German stock market index. Okay, so let's see how this works. Now we have an image. I know it looks complicated, but I'll get you through it. So the first thing we notice here is that we have no idea where this index is going, right? I mean, what we're observing is that in this case, we don't know where this is going. So let's have a look. So suppose that we observe this 1, 2, 3, 4, and 5 movement here. So we could say, this could be wave number 1. Why is that? Oh, because we actually have the 1, 2, 3 downwards corrective move of wave 2, and then we actually have a 1, 2, 3, 4, 5 wave which completes wave 3, another 1, 2, 3 down for wave 4, and again up for wave 5. So does this abide by what happens in what the rules were? So let's see. So can wave 1 be the longest wave? Well, actually, yeah, you could do it. It could happen that that wave 1 is the longest wave. But remember what we said. Wave 3 cannot be the shortest wave, but it appears here that it is. So our interpretation must be wrong here. So wave 3 cannot really be this the shortest wave. So what we're interpreting here is essentially wrong. Okay. Now let's try to reassess what we're looking for here. Okay. So what would be another idea is that at this point in time, here was the top of the previous wave number 5. So remember that the longest wave was number 3, which makes sense in this case. And wave 5 was not really that long. So we have again the 1, 2, 3 to 0.5, and then the 1, 2, 3, 4, 5. Sorry, 1, 2, 3 to wave 4, and 1, 2, 3, 4, 5 to wave 5. Okay, so what we're observing here is that, oh, okay, it appears that we have reached the end of a previous period. So what does it mean? What does it mean? The idea is that in this case, we have these waves which have shown the end of the upwards movement, and what we are observing is that we have reached the correction phase. So remember that the correction phase is actually a phase where where we observe a 3-point path, so to point B, then a 5-wave path to point A, and another 5-wave path to point C. Okay, so in this case, when we zoom in here, we find exactly this point. So we have 1, 2, 3, 4, 5 to point A, 1, 2, 3 for point B, and 1, 2, 3, 4, 5 for point C. Okay, so it appears that this actually makes a better explanation as to how this has evolved. So at that point, we have reached the end of the correction phase. Are we over? Well, unfortunately not. So remember that what we saw here is that we have seen the end of the correction phase, and now we've just started going upwards to a beginning of a new phase. So what happens is that what we observe here is that we have this was the end of the corrective point C, and then we started off again with wave 1. So wave 1 goes up again, wave 2 comes down but doesn't cross below wave 1 to the start of wave 1, so we're good with this point. And we have that wave 3 actually begins now in a longer term movement. So we go again up, down, and up. So we've reached the end of wave 3 at this point in time. Okay. Then at the end of wave 3, then we have again the wave 4, which goes down but does not cross wave 1 territory. And what we saw here was a question of whether this is wave 5 or whether it has actually been the end of wave number 4. Okay, so remember that interpreting into Elliot waves can be a bit tricky in practice also when you see real life, but we remember the rules we had. So in this case, what we see here is that from the top of wave here, we see something that has gone actually to less than 23% of the Fibonacci levels. So the question that comes here is whether we observe that these price movements are actually going to make a difference. So what we can say is that we can associate actually a very, very, very important support and resistance levels, which will show the future movement of the index. So, for example, we set the close support level here, sorry, resistance level here at the 23% Fibonacci level, and we set the next support level here at the 0% Fibonacci level. So if our index actually crosses either of the two, then we will have more we will have a greater understanding of how the index works. So we can play around with this thing as well. So see that once it crosses the 38% level, it keeps going down again. Again, if it crosses the 23rd, it keeps going down. So it shows that it's going to go up. So what happens is up to us to find out. Okay, so the idea is that we try to understand how things work, but we really need to keep an open mind. Doesn't mean that if we see that, for example, it is a 5-wave movement, it definitely needs to be a 5-wave movement. It doesn't have to be like that, so we have to be very, very careful that our analysis fits the Elliot wave criteria. Okay, so that was it for today from both of us. So if you have any questions, feel free to ask us. Let us know what you think. We'll give you some minutes to think about it.
Yeah, we know that it's quite it's not an easy topic. It's not an easy it's not an easy pattern to identify. So don't hesitate. Just stick box everything that you want that you don't understand. Just stick it in the box. We'll try to explain as simple as possible.
PDF file, no, but we already have some Elliot Wave analysis on our analysis website, so feel free to get that from there, Hamed. So if you search Elliot Wave in our analysis website, you can find lots of information on that, and you can actually watch this thing again if you prefer. So any other questions?
So okay, until I will wait a bit for your questions. So until you do, I will just present to you the forthcoming webinars. So like every Tuesday, we have a live analysis. Next week we'll also have a session for price action trading, featured transformer and commodity channel next Thursday, scalping with Heiken and Ashi candles by Stuart in 2 weeks' time, and the importance of emotional control. Emotional control actually is something that is quite linked with Elliot, because as we said, it considers Elliot Wave. It also is based on the investor psychology, as this graph presents to you. This was taken by forexadopt.com. So we are tend to be affected by our emotion and maybe by greediness sometimes. So that's not really a good advice for a trade. That's not a really good advice for trading, where you have to control yourselves and your emotions. So anything, we have a question. How do you deal with overly extended wave 5?
What do you mean overly extended wave 5? I mean, if it lasts for longer, that's not a problem. That is not a problem at all. So all it means is that it doesn't make a difference if we see a wave 5 that is overly extended. It shouldn't make a difference to us actually. So the only thing that matters is that wave 3 is not the shortest one. That's the key difference here. So wave 5 can actually be longer than wave 3. It can be longer than wave 1, but it cannot. But wave 3 cannot be shorter than both wave 5 and 1. So it doesn't matter with overly extended wave 5. Think of it as people just pouring in money. They found out that stocks are hot. They found out that I don't know, for example, in the early 2000s in the US, everybody wanted to invest in a stock market. Everyone wanted to get a tech stock. Everyone wanted to go and get some money on that. So this was an extended phase number 5. So this went on and on and on and on until some point it snapped. So this is how you will monitor it. So if you see that wave 5 has actually gone much higher than you would expect, then again, then put your stop losses, examine your exit strategies, and see how you can exit more without losing any capital, or basically getting all your profits and securing them.
So it's all about risk management, right? If you set your stop loss and your potential and your target, you don't really, you cannot be really affected by an overextended wave 5, right? So, and at least as you don't have a sign of reversal, either by an indicator or by reversal to the downside, for, let's say, if we take to consideration this example, if you don't have any sign of reversal, then it's likely to continue to the upside. So however, it's always about risk management, right? Set your stop loss, set your target. Even if it reverses, you will not face major losses, okay? So if you do that, you don't have to worry about an overextended wave.
When you say truncated, not meeting the desired target, what do you mean? I mean, if we actually go back to what we said about in the previous slide, so see that wave 5 is a bit bigger. So long that wave 5 is actually above wave 1, it doesn't make a difference. It doesn't matter how short it is. So if wave 5 is shorter than you believe, then you should set your stop losses or your take profits at a specific. What do you mean failure for wave 5? It shouldn't be. Failure for wave 5 doesn't really mean something. I mean, unless you're talking about something else. What you're referring to is really, if you have a shorter than expected wave 5, then it means that either you're going to continue later on with that, or if you do not have a proper wave 5, it could be the case that something is wrong with the analysis overall, which shouldn't be the case, because other previous signals should have indicated that this is not a proper the proper way to interpret the waves. So remember again that when you interpret the waves, you really need to make sure that these abide by the criteria we said before. Okay, so again, so long wave 5 is above the area of wave 1, you can actually consider it successful. So it shouldn't be that it shouldn't matter how long the duration is or how much it goes up. Alternative counts?
You mean something different than Fibonacci?
You mean how we can interpret things alternative in a different way? So this is what we said in our example. So when we came here, let me show you. When we came here, we said that this was not the correct way to interpret these things, because what we faced was that they didn't fit the theory. So, for example, wave 3 in this case could not be the shorter of the three waves. Okay, so what we needed was to reevaluate what mattered. So we again did a different interpretation in order for the waves to fit the theory. If they don't fit the theory, then it means that you shouldn't use Elliott wave to trade. I mean, it's that simple. You don't risk doing something you don't understand. I mean, the idea is that you see if the theory agrees with what you observe on the data, on the chart, and then you decide whether you will go through the theory.
Any other question, guys? Anything you want to ask before we end up the session? Because we're nearly an hour and a half. So, any other questions? Remember, you need, in order to trade something like that, the rules and the guidelines that we presented today need to be satisfied. Otherwise, you don't have an Elliott wave theory. That's what Nektarios just mentioned. Yeah, these rules need to be satisfied. Otherwise, it's not an Elliott wave. Simple as that. Okay. So yeah, stick on these rules and on these guidelines in order to trade Elliott wave, if you have, of course, identified one. Okay, so we reached the end of the session. For any questions, please email it to us at webinars@hotforex.com. We really appreciate your attendance in this webinar. So as I don't see any further questions, I will have to end the session. But anyway, you can contact us either in Facebook, Stuart Hot Forex Cowell Facebook page, or straight to our email address, webinars@hotforex.com. Thank you for watching.
Thank you all for being here. So we'll see you next time or next webinars. Until then, trade safely and well, try to take over. May the trend be with you. Yeah, may the trend be with you.
Take care. See you. Bye bye.
Good shame. How romantic is being investigated.